If you take all properties on your usual property portal in any real estate market, you typically would have, for any substantial market, around 100,000 plus properties at any given point in time that are available for sale. Imagine those 100,000 properties or more, you could automatically value every single one of them in real time. And you would compare them with the listing price, and you would sort them from most undervalued on the left to most overvalued on the right. Now, imagine your average real estate investment return, and think about the return of the properties on the far left. If you would have that information, you would immediately pick up your phone and call the listing agent, because that's a great investment. But if you don't have that information, you may as well be unlucky and you pick up a property that is on the far right. To figure that out, that is exactly what I set out in 2017, and to try to answer that question for my own personal investments. My name is Wim van As. I'm the co-founder of two companies. Exprovise Technology, it's a real estate startup registered in the IFC in Dubai, where we analyze the real estate market of Dubai in great detail. And Elgovisory Real Estate, which is a boutique brokerage company where we focus on real estate investment advice to retail and institutional investors. We analyze the entire market, residential, commercial, the low end, the high end. But for today's presentation, I want to focus and zoom in a bit on the affordable residential real estate segment, because I think that segment is the most important. It's also the largest segment in the market. Before we begin, quick disclaimer. None of what I'm about to say constitutes investment advice. You should all make up your own mind when you do your diligence on an investment. But if you want to take a pen and paper and make a few notes, I'm not holding you back. I'm a numbers guy. I'm an engineer from background, so I try to understand the world through statistics. Here's how I look at real estate. Fortunes have been made and fortunes have been lost in real estate investing. It pays off to know what you're doing. Unfortunately, real estate as an asset class in the world of investment is probably the largest investment asset class. It's also the least transparent. Real estate is very local. There's a micro dynamic that plays out at a very local level, and there is a lot of information bias. If you're lucky, you know something, you can take advantage in your investment. If you're unlucky and you didn't know, your investment may turn out to be quite affected. In particular, in the world of affordable real estate, as I will go through the presentation, you'll see that the target audience, your families, your first-time home buyers, they are in particular at risk for the risks involved in this segment. Before I continue, I want to share one small anecdote. In Belgium, there's a compatriot of mine. He just published a book last year, How to Get Rich with Real Estate Investment. Before you rush out to buy this book, I have to disappoint you a little bit. It's only available in Dutch, and it's very specific to the Belgian real estate market, which is high taxes, very high labor cost, energy cost, and the paper burden if you want to do real estate development, if you want to invest, it's an enormous hassle. Nevertheless, this guy made it work, and he published a book on how to do it in that very tough market. But here's the real kicker. He's blind. The fact that he's blind actually gives him an edge. He's not biased by looks, marketing pitches, nice renderings. He really just looks at numbers. And that's exactly what we do. We just do it a little bit more extensively and rigorously. But I thought it was a nice anecdote to share. History is a great teacher if you know where to look, but we often forget about big stories that happened even if they were just a couple of years ago. So I just quickly want to present 3 stories of numbers going wrong at scale. The first one you may be familiar with, the biggest real estate portal in the US, Zillow. Many years ago, they set out with this new idea. They said, look, we're going to offer sellers of properties a cash offer within 24 hours, and if the information they provide to us is accurate, the offer is binding. The idea was they would offer the seller a very quick transaction, and because of the data they were sitting on and the algorithms they were running, they say, look, we can at least make 8 to 10% margin on putting it then up immediately after, back for sale, and we give a bit more time. They thought this was going to be very profitable. They made a big case about it. Stock went up because everybody thought like they tapped into this new potential. A couple of years later, turns out they got the algorithms a little wrong. They made substantial losses and write-offs, and even today, I haven't looked up the stock recently, but I don't think it has crossed $60. It really went down, and they didn't recover from that. Another example you may be more familiar with is the Chinese real estate market. Now, the China market still today is in a perfect storm. Now, this article is already a couple of years old, but I didn't want to update it because I want to show just how persistent some of the risks can be if you get it wrong. And when they got it wrong, 1 was over leverage and 2, oversupply. The challenge with over leveraging you can solve. Yes, it's going to hurt a little bit. Some people will have to take a write-off. Some of the negotiations are going to be tough. But it's a solvable problem. The challenge with oversupply is a far more difficult problem to tackle. Because even the next owner, whether that's the government taking over or another investor that comes in and takes the asset on a distress, your prices are defined by supply-demand balance. And if there's no demand, your prices will continue to spiral down until the balance settles in. So you may as well be trying to catch the dropping knife in that situation. And still today, they are not out of the woods yet, and it's a very difficult problem to solve. A little closer to home is the UAE property market. Today, people have forgotten, but a couple of years ago, this is also an article from 2021, came out talking about the oversupply of the UAE property market. Memory very often is very short term, but that was a real concern. And many developers in 2021 also had a real concern about the stocks they had left on their balance sheet. In fact, if you saw it coming, there were quite a few very good investments to be done at the time. Developers were selling at discounted prices, and in particular, they were offering very attractive payment plans to get rid of the stock. Now, truth be told, the problem wasn't solved by the real estate sector. The problem was solved by the government with their economic stimulus packages, attracting a substantial additional demand that wasn't there in the market before. So today, all that supply was absorbed in the market because demand really ramped up. But if that wouldn't have happened, we would be talking in a very different situation about real estate in Dubai today. And the UAE, as a country, is relatively small, so attracting extra population can balance things out obviously a bit more easily. But if you have to do that at the scale of China, you can quickly understand that the problem is substantially different. I came first to the Middle East in 2010. I was a salaried employee in petrochemical industry, living here. Actually, I first came to Riyadh in 2010. I lived in Riyadh for 2 years with my wife and my youngest son. And we built up some savings, and in 2014, we had enough savings to make our first down payment on a house. I wasn't running any analytics at the time, but we were happy to call a house our home. And instead of giving money away to the rent, to spend it on building up our own family equity. Turned out I bought at the peak of the market. After that, for 5 years in a row, step by step, the value of the property went down. Meanwhile, we kept paying the mortgage. Interest rates also increased. After the first 3 years, you get from your fixed rate to your variable rate. So it wasn't exactly a very nice situation to find that out by accident. In 2017, we had a little bit more savings on the side, and then I wanted to make a real estate investment, a real investment, and I wanted to avoid the same mistake as I was doing back in 2014. Now, I started my journey like everybody else. You go to the property portal of the local market, you look at different properties, you look at properties for sale, properties for rent, and you take your Excel file, making little business cases, and if the property passes your criteria, you pick up the phone, you call the agent. I end up looking at more than 100 properties in the next 6 months. I didn't buy any of them. Every phone call I made, every viewing I did, turns out the numbers weren't exactly as they seemed on the listing. The property was completely fake, or it just happened to have just been sold, but they had this other thing that was always slightly more expensive and slightly less good as the thing that you picked the phone up for. So I thought there had to be a better way. And I reached out to the data providers in the market, B2B data providers, the pre-version, if you want, of PropTech companies, to see, okay, what do they have? And very quickly I realized that the data is too aggregated, too high level for an individual business case. It doesn't make sense to know what the price of an average apartment is doing across the whole market if you're looking at a specific 2-bed apartment on a low floor with a view of the park in a particular part of town in a particular new project. So I said, fine, I can do a little programming myself. I'm an engineer from background. I'll do it myself. That was the last option. And I set out to develop a set of algorithms to address some of the problems that you could spot on the slides if you look carefully. These are all public information, and I took a variety of sources. I think one of the best examples of how to get it wrong is on the top right. That's Zillow. It's a property, I think it was a top price property at the time when I made the slide in Manhattan, in New York, listed for 79 million, and their estimate, I'm not sure if you can read it, but it was around 11 million. You could see how the disaster of the e-buying activity started to build up. That's really an example of being clueless. And your brokers, very often, they are locally anchored in the market. They actually know. In this case, I don't think the listing price was wrong. But the algorithm got it wrong by a factor 8. Imagine that's what you use to base your decisions on. Now, truth of the matter is that, and many of you will realize this, this is the type of data that companies in the real estate market are using to base their decisions on. And I thought there had to be a better way, especially if I am putting everything I had built up over my 15-year career in employment on the line for a real estate investment. Fast forward a few years, I was able to quit my corporate life. I became a full-time real estate investor, and I live off my real estate investments. And I've decided, end of 2021, to commercialize that and create the 2 companies that you saw a little ago. Here's a couple of the learnings that I want to share in general about real estate and real estate investing. And then afterwards, I'll dig into the affordable real estate segment. At the risk of kicking in a few open doors, first and foremost, prices are defined by demand. That's easy. Look for population growth. And the way we do that is we do it in a layered manner. We look at demand at the city level. We look at demand at area level, at sub-area level, and we even go to street, block, or individual project. If you made a bad investment decision but population is growing, time is your friend. That also holds on the other part of the equation. If population goes down in a certain location, demand goes down, time is not your friend. Next up, the next obvious one, supply. Look for scarcity of land. Again, easier said than done, especially in this region, because there's still plenty of land available. But you can find pockets of areas where supply starts to be very constrained. And ideally, you look for city centers where there's no land available anymore. And then if you want to do one notch better, you go for places where there is high rise. Because low rise, you can always tear down and you build high rise on top of it. But high rise, to tear it down and to build super high rise on top of it becomes economically unviable. Next up, this is also very important for any buyer in the segment. Great quality plus poor marketing gives you far better results than average quality with great marketing. Most developers are excellent in marketing. This is their bread and butter. Don't be fooled. Don't be scared either. Do your diligence, but look through the marketing part of the equation. And spotting quality, if you're not a construction engineer, is very difficult. If you're not sure, hire an inspection engineer to help you out and make sure you buy good quality. Next up, and I can say this because I'm a certified broker and I own a broker company, high commissions, bad returns. Keep in mind also when you do off-plan purchase direct from developer, very often there's a broker involved and they will tell you, no, this is zero commission. That's truth and lie together. Yes, the buyer doesn't pay, I see you laughing so you understand what I'm talking about. The buyer doesn't pay commission, but the developer offers a kickback to the broker. You just don't see it as a buyer. And if you have a little peek under the surface and you look at the different projects with any given developer, you will see that the kickbacks are the highest on the projects that are most difficult to sell. That is obvious, but as an investor, you need to find that information because the broker is definitely not going to tell you. This is also very important, especially in the current state of the market. Prices and payment plans on off-plan launch reflect the current sentiment of the market. They do not reflect intrinsic value of the property. Today, it is unfortunately very difficult to spot good off-plan launch projects because the state of the market, the sentiment is very high. Meaning the payment plans and the price points you receive today from developers are very often not even comparable to the quality of deals you can do in the resale market. That doesn't mean every project is bad. Most of the projects are good. It just means there is a significant difference in investment quality between the two at the moment. Next up, this is the part I am not going to share because we keep it privileged for our investors, but I'll explain a little bit. In the data, we spotted a microdynamic that is very persistent throughout different market sentiments, different projects, different locations. It's mostly to do with the timing of a purchase. And lastly, and that comes at the very end of the chain, if you have a choice between multiple units and you can choose between a better unit at a reasonable price or a slightly lesser unit but at a great price, pick up the superior unit and pay a little more. This is very equivalent to, back in the day, a statement that Warren Buffett once made about investing. And he said he learned it from the former Charlie Munger. Charlie Munger taught him to buy great companies at a reasonable price over average companies at a discounted price. And the same is absolutely true in real estate. The first two you can summarize as focus on city centers. Then You select the developer or the project master project, then you select the individual project, you look at pricing, you look at timing, and you look at the specific units. Now there's an overriding learning in this, is that there's an order of logic in the criteria. If we go from the bottom back up, you may have the best unit, and you may have picked the greatest time of purchase at a very good price with a reputed developer in a great project. If the population on the location where you're buying is going down, or there happens to be a new project at a big capacity that is launched just next door to you, time is not your friend. And all the other things, over time, they don't matter that much anymore. What have we learned about affordable real estate? Two parts. First, we look at the real estate itself. Affordable real estate is the bottom of the market. And you can take that quite literally, because that's why it's affordable. Now, if you look at the dynamics and the trends over time, if the market goes up on average, the affordable segment also goes up, just a little bit less. If the market goes down, the affordable segment is the segment that goes down more. And that is because when you look at different segments in real estate, there is an inflow and an outflow across different segments, except for the segment at the bottom. If the market goes down, people who can afford, either tenants or buyers, the same budget, they tend to trade up. They go to a better location, or they move to bigger real estate. And so that segment is the first hit by occupancy rates. And that eventually then translates to prices. It's also the segment with the poorest quality. That doesn't mean everything is bad quality, but it does mean that developers, in order to preserve margins, have to economize somewhere. And that results down the line in higher maintenance and repair costs, which are often for the tenant or the ultimate homeowner, but you don't necessarily get to see that at the start of the project. It's a segment where there is a trade-off on the commutes. Lower real estate costs, because it's a little further out. If you want to develop affordable real estate, you start with lower price land, which tends to be to the outskirts of the city. It also means your time to commute to schools, to shops, goes up. That's a cost that you also need to factor in. It's a larger segment. If you look at population, people own usually, or they rent one house. The segment where people own multiple homes is actually quite small compared to the affordable real estate segment. If mismanaged, as I showed on one of the earlier slides, problems can last for decades. And in particular, the risk of oversupply is a very important one. FOMO marketing. Now, FOMO marketing you will see across all segments, but in particular in this segment. If you don't buy now, in the next 2 minutes, we'll offer it to the other one, and you will miss out forever. And this comes in different ways. They also stage the capacity that is being put into the market. So a project is sold out, but actually what is sold out is 10% of the ultimate project, the first phase. As a buyer in the affordable segment, you have plenty of time. Lastly, and this is something as regulators should probably pick up on more closely, very often you don't get commitments on the facilities, the services, the features of the community in your sales and purchase agreement. When you buy offline real estate, it will tell you, okay, this is the unit you buy, these are the characteristics of what you buy. But when you go to the sales center, they will show you all the nice renderings, all the facilities, how the community is going to look like. They even show you your apartment furnished, even if it's not furnished. What you see is not what you get. Last one in this segment is that because most buyers are mortgage buyers, mortgage valuation reports are bad. If you ask 5 companies to value a property, you get 5 completely different results. And it's almost impossible to challenge them because there is this perception bias, impartiality that the banks want to maintain. The biggest mistake in these reports is they don't capture the trend. You may be very right on the value of a property, but if the trend goes down, your mortgage may be 20 years, you are at risk, the bank is at risk, but after a couple of years, that risk shifts to the lender. If you look at the people, there are quite a few aspects. First off, it's young families. It's people starting their careers, having a bit of savings to make that first down payment. They're the bedrock of your economy. If they get it wrong, it's very bad for the overall economy. If they get it right, it's good for your economy. This is what is currently playing out in China. Middle class, very strongly affected by the fact that a big part of their savings has been wiped out from bad real estate investments on projects at risk that they shouldn't have invested in the first place. Consider the full cost, maintenance, repair, service charges, taxes, and commute time, which very often is not a conscious thought process of this buyer segment. This is an important one. If you open any book of investment, in the first chapters, you will quickly see something that says in the likes of, never put more than 5% of your entire net worth into a single investment. Here, it's the exact opposite of that investment advice. In this segment, your buyers, they're all in. Very often, they're so much all in that they put nearly all their savings to date into the down payment for the mortgage. And then you have the mortgage itself, which puts your earnings potential on the line for the coming years. If you calculate the investment size over the net worth in this segment, we're talking easily 500% or more. In this segment, you put your future at risk. That is why this segment is also very worthy of protection by regulation to avoid mistakes from happening. Credit checks, they only happen on the income. Yes, the bank does a valuation report and asks that before they give you the mortgage. But when it comes to credit checks, they only do it on the individuals. They don't check in the long run what the value of that real estate is going to do. And they are, in general, unsophisticated buyers. Typically, they do more financial diligence in buying groceries than in buying real estate. And I have to say, even the smart ones, they're just a little bit smarter in telling themselves that the decision they made is the right one, but that doesn't make their decision more rational. They just convince themselves that it was the right thing to do. Highly susceptible to marketing tricks. Real estate decisions are some of the biggest decisions people in this segment will make in their lifetime. It's a mental burden. People want to get rid of it quite quickly and get over with it and then move on to the next. In summary, this segment is actually the highest risk segment in the real estate market. And governments, banks, developers, brokers, investors should all take very much care of protecting this segment for the risks involved. Where is the potential in PropTech? And where is the role of PropTech in this challenge? In one sentence, I would say it's to bring clarity on the value, on the trends, and to make transparent the risks. Accurate and fair valuations, avoid overpaying and underselling. Help decision makers to manage supply and demand. Use rental analytics as canary in the coal mine. We use rental analytics as early warning signs on spotting great investments, but you can easily use those same analytics to spot if the market is getting overheated or if something is changing on the demand side that will turn out to become a problem further down the line. Many of the big problems we see on supply and demand, you could have detected them very much in advance. Assess risk dynamically across real estate categories. And in particular, the last one, we need to redefine the meaning of affordable real estate. Affordable should not mean cheap. Affordable means you're not losing money in the long run. First things first, how to get there. And this is really mostly focused on government agencies. Standardized, connected, and reliable master data. Transaction data on the market made available in B2B for PropTech companies to analyze. Relevant and accurate indices on the real estate trends, and proper data regulation. If you work in government, we have developed in-house many algorithms to address specific issues in that area. Please do reach out during the conference, because we'd be very happy to have a conversation with you on this. Next up, all the creative solutions can come, just to highlight a few, but for the sake of time, I'm going to skip that. Big potential. This is my last slide. If I see estimations of where is the PropTech market going to go, I think they're all understated. On the left, you see the US size of the equity market, $50 trillion, that was December 2023. And trading volume is about 3 times the size of the market. If you look at US real estate, $70 trillion in December 2023, and total transaction volume, 1/3. Equities, traded online in real time. You have proper financial reporting, extensive analyst coverage, many sellers and buyers, they don't know each other, high liquidity, fungible, with low transaction cost. It compounds over time, and the ticket sizes tend to be very small. Real estate is exactly the opposite of all these things. Most people start their speech with a question. I will end mine with one. What do you think is the net rental yield you need to achieve on real estate investment if you want to achieve the same results as the S&P 500 with dividends reinvested? If you think you know the answer, come and look me up and we'll have a discussion on it.